context and flow also, this is what I want to discuss for today with one goal in mind. No? The whole goal and narrative of this is for me to be able to give you value so that you will be able to execute and have the confidence and conviction because what happened in 2020. Because when the lockdown started, I kept mentioning this to a lot of people that these are the three things that you should look at for somehow maybe having a shot for the economy to get better, or at least that would shift the sentiment. I mentioned three things. Number one is the lockdowns, meaning how bad the lockdowns would be and how fast do we reopen. Second is how soon the vaccines would come out. Because the faster it is, the bigger the semblance that hey, we could come back closer to where we were before. And please do note, no, the difference between what hit the economy in 2020 versus other times before was basically what hit us was not because the companies were doing bad things, but basically we got hit by a pandemic that no one saw. And having a vaccine will give us a shot to go back at least close to where we were before. Number three is consumer spending. And from one investor to another, you do know that the Philippines, at the end of the day, is a consumption-driven economy, meaning as long as Filipinos would spend, the economy would thrive. However, last year, it was the opposite. Even if you had the ability to consumer spending. So those were the three things that I was telling people, look at this, because if you see something change and shift here, it may be that you may see that the economy is getting better. So now, here's what I want to show you. This is where we are in 2021. So if you take a look at it, number one, lockdowns. We are now in GCQ, but the government made the disclosure also yesterday, but by March 2021, we are moving into a MGCQ, which will be lighter. But I want to highlight certain things that are so different already in GCQ, just to show you that we're not going back to where we were in the middle of 2020 already. Why? Because if you look at it, for GCQ, manufacturing is back at 100%. Meaning, if you look at the context at the early part of 2020, those who could only operate were basically the essentials. And the reason why I'm saying this is you have to realize that when it comes to the economy, it's all about transactions. The more transactions that happen, the more the wheels will turn. What does that mean? One man's spending is another man's earning. And if you look at the second and third line, I want to highlight that one of the biggest that got hit were retail establishments, brick and mortar establishments, that even though you wanted to eat at your favorite restaurant, your favorite chain, but because there were restrictions or because you were scared, you could not do it. And now, GCQ, dine-in is allowed, not 100%, but people are starting to come back. People are starting to go to salons. People are starting to go to spas, nail spas, etc. Those dine-in centers, those businesses earn, they can spend more, and as they spend more, their employees can also spend more, and the wheels just keep on turning and turning and turning and turning, which was a stark contrast to where we were when we had the strictest of lockdowns, which also I don't think we're going back to that lockdown before. I'm going to talk more about that later. But anyways, number two, the vaccines. This is something that the government projected. Execution also would be different, but this is the plan for 2021 quarter one. 5.6 million people vaccinated, and then projected that by the end of Q2 2021 there would be 9.4 million, which in my opinion this is already exceeding expectations, because when you saw interviews of people March 2020, April 2020, they would always say that the vaccine would take a year or it would take 2 years before it could fully be out. But if you saw the news from last year, around the end of 2020, November, December already, yes. So in terms of timetables, I really believe that this is a game changer in terms of sentiment, in terms of people becoming more confident also in going out, people becoming more confident in spending, people becoming more confident on having a shot, that how they live their lives in 2018, 2019 would somehow come back. And lastly, consumer confidence. What's interesting about this is I myself know when the lockdown started, I wasn't going out. I barely went out. I went out for essentials to buy stuff that I really could not order online. But the reason why I'm sharing that is this, and comment, put it in the comment section if you experience this too. That there was a tipping point, somewhere around October or somewhere around November, that you suddenly felt more confident in going out. I don't know, because it was Christmas. I don't know, maybe because you wanted to see your relatives that you haven't seen for a very, very long time, or you needed to buy stuff already for the holiday season. But people suddenly became more confident that, oh, the virus won't go away. I'll just be more careful. That's why you saw more people start going to malls, more people started walking out. But the difference lang is people are starting to adapt. People are starting to see that even if there's a vaccine, or even if we don't go back yet to where we were before, I'm gonna try to have a shot that I get to live my life the way I lived it before. Although a bit more careful, although a bit more protected. I wash my hands more. I sanitize my hands more. I put sheets. But here's what I want to show you. Right after that crisis was followed by enormous, massive, massive growth. After that crisis was a very, very large recovery also. But let's move forward again. Right after that, we saw this. After the large push up, another massive drop, consolidated for a bit, and that was also triggered by the 2008 global financial recession. But what's interesting about that is this, the global financial recession was not something that happened because may masamang nangyayari sa Pilipinas. It was something that was triggered, was this. Another massive, 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 massive move up. That being said, fast forward to where we are right now. This is where we are. And if you look at it, I'll give you a few seconds to look at the chart very, very well. The conditions may be different, but history, statistics, and numbers, they're almost the same. Large move up, there would be something that would cause it, 1990s Asian financial crisis. Then large move up, there would be something that would cause the economy to start to fumble again, global financial crisis. And then to where we are today, last year, 2020, coronavirus. Among the three, this is the only one that's triggered by healthcare issues. This is the only one that wasn't really caused by something wrong in financial markets or institutions. This wasn't something that was triggered by a bubble. As what I mentioned at the start, the crisis was not caused because corporations, companies in the Philippines were handling their business wrong. It was something that was caused because there was a pandemic that no one oversaw, or no one foresaw at the end of 2019. No one at the end of 2019 knew that at some point in the first quarter of the year, we would have 90 plus of the economy shut down. No one knew that. But I want you to take a close look at this. We are right here, right smack, similar to what happened in the 90s, similar to what happened in 2008. We are at a very, very opportune time. That when people are saying that there's so much uncertainty, I say that there's so much opportunity. Because what's scary is when markets continue to go up, the next rationale is it would retrace and go down. But what if you came from a portion where kakabagsak nyo lang? And the reason why I'm saying that is this. Recessions are cyclical. It's not a question whether a recession will happen. Please do note that in the next 8 years or 12 years or 14 years, another recession will happen. I don't know what the cause is. I don't know where it will come from. But what I do know is history and numbers have shown that a recession will happen. However, and this is not what's talked about a lot. People keep saying we're in a recession, things are so bad. But I want you to zero, seeing history, seeing how things have went. You should be excited right now that, hey, the worst might be over. We don't know when we will fully recover, but numbers have shown that we shall recover. And now should be one of the times for you to start deploying and be more aggressive. When the lockdown started, true enough, it's okay also to keep cash. But now, as things start to open, now is the time for you to start to become more aggressive. And that being said, I don't want to underpin that there's still a lot of uncertainty. I'll never I That's something that is part of it, because we are in a pandemic that we have never experienced before. But if there's one thing that I do know is this: when you analyze things, the first thing that you could look at as a indicator of how sentiment is, of how people think and perceive, or how optimistic or pessimistic they are. It's basically you looking at the stock market. What do I mean about that? The stock market is a forward looking market. The stock market is an indicator for you, telling you whether people are more aggressive on how they are looking at things, or they think things are still bad. And I want to show you this. This entire area that I circled around here, this was March 2020. And at this portion also where there was a large drop, this was when cases in the Philippines started to happen, but we have not locked down yet. Then when we started to lock down, boom, you saw a sudden drop already, meaning at that point in time, people were already pessimistic. People were thinking the worst. People were thinking after dropping from 7.8 to intraday 4,000, 7.8, 4,500 at the close. Right after that, look at this. Market started up until the close of last Friday. Market started to go up around 50%. Meaning, if you look at the trend at what's happening, you see the right side of the screen from where we were in March 2020 to where we are now. It's not a straight line. You're seeing dips because totoo, there's still uncertainty. But if the market is an indicator of how people are looking, I think it's more optimistic right now than where it was March 2020. I think people are now seeing things in a different light. It's not as scary as what it was before. Now let me give you some data. What's different in 2021? What has changed? What are the things that is that purely sentiment, or is there data for it? I want to show you this. Number one, basically, I really believe that there's lesser uncertainty now because we now have more data out. Di mo alam kung anong coronavirus, how do you get it, how is it spread, you don't know how to combat it, you don't know how to contain it. There wasn't enough testing yet in March 2020 than what we have now. There wasn't a lot of facilities where people can get isolated and get treated. There wasn't a shot of when the vaccine will come out, but now all of those things have been answered. And if there's one thing I know about investing is when people are uncertain, they try to keep cash. But as more data would come out, people start to see that, hey, it's not as bad as it seems. And the deployment of capital becomes more fluid, as what we saw right here. Anyways, before the lockdown started, one of the key things that I would look at in the Philippine economy are three things: OFW remittances, the BPO industry, and also consumption. Because I figured out, as long as these three pillars are massively, massively doing well, then there's a shot that the economy would be good. And before I put this talk to a close, I want to show you, meron ba talaga nagbago? Should there be something that you should be alarmed about? I want to start everything off with remittances. Remittances for 2019 was very, very high. Remittances for 2019 was 33.5 billion US dollars. Please do note that's so big. If you put it in context with other countries, that remittance is already bigger than some GDPs of some smaller countries. That's how big it is. Now, when the lockdowns happened, people were pegging that, analysts were pegging that we might see remittances drop to around 20% or to as low as 40%. Meaning, if it's a 20% drop, we would probably see remittances go low to around 27 billion US dollars. If it's 40, it would drop to around 21, 22 billion US dollars. But let me show you this. These are the remittances from 1990 to where we are today. I want to tell you this, that even if we dropped by 20%, it would have still been 25 billion. If you notice the stark difference, 1990s to early 2000s, 20 smaller than Q2. However, I want you to see this. Fourth quarter disclosure, largest fast food chain in the country, 2 billion pesos. Meaning, it's not where they were in 2019, but things are starting to pick up once again. I think foot traffic for Jollibee was around 70%. Shakey's, Max, SSI were lesser than that, but it's starting to pick up once again. So why am I saying this? I went to great lengths to tell you that I don't think we're going back to March 2020 levels anymore. Eh. That that's just fear that we might go to something stringent, but the data is telling us otherwise. And that's the arbitrage. And that's what I believe where you can make money from. When everyone is so scared, when everyone is so fearful, but the data, history, statistics are telling me that, hey, it's not as bad as what people think it is. That's what I think. That's where I think wealth could also be created. And that being said, just before I'm about to close, I would like to leave you that you have two choices. And the fact that you are listening, watching this webinar is you are pretty much inclined to invest in the real estate market. You're pretty much a property investor. That if you are inclined in the property sector, given everything that I've shared, two choices. Number one, you invest while we have not fully recovered and wait, or you wait until we have fully recovered and that's where you invest. There's two key words that I want you to focus on and I made those letters larger. It's you will invest and you will wait, or you will wait and you will invest. The only difference is this. When you invest, when everything is not so rosy, everything is not so perfect, and then you wait, the upside is bigger. When everything is not so perfect, when everything is not so secure. You think about BGC 2001 versus BGC 2021. In 2001, you did not know what would happen to BGC. It wasn't perfect yet, but the upside was bigger. BGC 2021 compared to 2001, the upside in 2001 was larger. There's nothing wrong waiting and then waiting for things to get better and then you start to invest. There's nothing wrong with that. That's totally fine as long as you invest, as long as you deploy capital. But if you're looking for a return, you're looking for upside, whenever there's uncertainty, when everything is not so rosy yet, that's the best time to deploy capital. Because this is what I believe. When things get better, similar, remember the chart that I showed you earlier? When everything starts to get better again, the BPO starts going above their previous highs, remittances starts to go back to their previous highs, consumption goes back into full throttle, then tourism starts to open up more. Given that also on a broad level, no, property prices in the Philippines have somehow held its ground. We are not going back to 2019 level. So if you are looking for what upside would you want, I'd say that given the factors that we have right now and given the data, it may not be as rosy yet, but it's not reckless to start deploying capital. And I want to share this. While all of these lockdowns are happening, while the pandemic is being treated, while they're trying to fix everything, I want to zero in on this. That while all of this is happening, infrastructure is being built. That from one investor to another, you know this, that every time dinaanan yan ng skyway, every time dinaanan yan ng development, prices where it starts, where the roads would pass, and where it ends, property values in those areas would increase. Just think about the new skyway. Just think about how MCX has appreciated prices in that area. And that's how it will be in the midst of the pandemic while all of these projects are undergoing. And lastly, this. Interest rates are low eh. The reason why we want to invest in property is mainly because we don't want the volatility. The reason we want to invest in property is we want a storer of value. The reason why we want to invest in property is because we don't want to buy something then later on it's lower. We just want something that it won't be volatile, but I know it could give me appreciation over the long term. The thing about that is this, because rates are so low, you won't see that in your cash accounts. You won't see that in bonds. And the best bet, in my opinion, is still property because rates are so low. Now, that being said, your investing strategy in the midst of all of this should be this. As long as your cash flow is not interrupted, meaning alam mo may papasok pa rin, you can still forecast that over the next few months your income is still there, then you have a large you have a cash buffer that will protect you should your income also get hit. And you are looking at what your investment will be, not for the next 2 months, not for the next 4 months, but you're looking at a longer time horizon.